Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, December 5th, 5:20 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, bear market rally underway. I talked on Friday that I would hope to just change this to uptrend if we saw follow-through strength from the last 3 days of last week, where a big move up on Wednesday based on some perceived dovish comments by Jay Powell in a speech, followed up by consolidation days on Thursday and Friday, and in fact a gap down but recover on Friday on some bad economic news, led to at least my expectation being positive coming into this week, but that was undone in a fairly significant way today. We've got some good, some bad, and some ugly. We'll get through it all by the end of this video. But for now, we're staying in bear market rally. Let's go over here to the trend gauge. Leaders still holding up fine. Short term, 21-day exponential moving average, we've been above this. We've been on bullish uptrend since November 11th. But the green sub arrow is rearing its ugly head. That means we had a failure below the 21 on at least one of the indexes. We'll take a look at that when we go through the charts. Medium term, we're still firmly above the 50-day moving average, as it's really not even coming into play versus the indexes, because it's just changing its slope from negative to positive, and we're so far above it that the data is somewhat skewed. On the long-term 200-day moving average, the sub arrow changed to red, because if you look at what just happened today, S&P 500 led lower by energy and financials, back below the 200-day moving average, still above the 21. We'll check all the charts momentarily, but let's go over the numbers for now. G6, this is our 6 growth ETF composite, hit hard today, down 3.1%. S&P 500 gap down 0.75%. No gusto at all today, down 1.8%. NASDAQ 100 down 1.7%, Dow down 1.4%. Here's the concern. Mid-caps down 2.5%, Russell 2000 down 2.8%. We'll talk about why momentarily. Global Diversified 60/40 down 1.24%. In-house GROTECTION down 1.47%. We've got some alpha versus the S&P each of the past 3 sessions, but net, we're just basically where we started. And that's obviously not what we want to do, as we've added incremental exposure based on the gains that we made. Down less today, but we did do some hedging, and we'll talk about why as the video proceeds, and we'll go through the tail of the tape and charts of interest. So first of all, why we do what we do here at Revere. We are an active manager who takes our cues from what's going on in the market. This is a chart of the S&P 500. Let me reduce the size of this a little bit more so you can see. We evaluate the health of the market based on how leading stocks are acting and how the major indexes are acting. And we do it across 3 time frames, as I showed on the trend gauge on the prior page. When we're trending above all 3 time frames, we are fully committed to the market. If we start to turn sideways, our stops will take us out. If we start to roll over, the slopes of the medium term and short term moving averages will start to roll over. We'll get more defensive if we break below the black line, like we did in January of this year. We will get to a significantly defensive posture, and that's because of these stats right here. Risk management, our number 1 job here at Revere. You handle the drawdowns, the returns take care of themselves when the market returns to a healthy posture, which we had hoped we were seeing based on the action at the end of last week, but some of that undone today. But some reason for optimism, some reason for caution. We'll go through and place all the check marks in the appropriate columns by the end of this video. But what we strive to do is stay away from the significant losses. And why? How do we know when to do that? Because all of them take place below this black line here. The black line is the 200-day moving average, and Usually from the top until you break below there is on average 12%. Not difficult to come back from a 12% downtrend. It's difficult to come back from 30, 35, 40. We were down 27.5% at the lows this year. That was on October 13th when we had a slingshot back to the upside. You just don't go down forever in the market. The market said that's enough. We've been rallying 2 steps up, 1 step back for a while. Still in the positive column, so you can see here, let me blow this back up. We are okay there. So we zoomed it in. So you can see here last week the move above the 200-day moving average. 2 days of consolidation, in fact, an undercut and reclaim. Let's go to a 15-minute chart. You can see that on Friday. So we had this gap down on strong economic data, which is not what we want to see. It was the employment report. But that gap down put in the low and we trended higher all day, a very good sign. The opposite today, gap down and just worked our way lower. So we've retraced about right at the fib level, 61.8% of this move from the low of the Wednesday of Powell's speech to the high of Thursday morning. We've retraced 61.1% of it is like right at 4,000, which is where we are. So we actually undercut, got right back to it today. We, in quick order, need to get back above 4,007 and the 200-day moving average. You can see on a 15-minute chart, we're quite oversold here. You get various stochastic readings depending on what time frame you're looking at. On the bad side, this is put this check mark in the bad column. We've rolled over again on the stochastic, and when you're rolling over from overbought, you're at a danger of a type of a waterfall event. So that's why we started to put some hedges on today, and I'll talk about why we did it. But really what we're focusing on next, 2 levels, today's highs, we need to get back above it and above the 200-day moving average and the 21-day exponential moving average. That's the green line. That's our short-term moving average. Right below there, I have a 150-day on there. That's the Stan Weinstein stage analysis level. That should provide support. 50-day moving average is 4.7% down. We're not even factoring that in at the current point because of how low it is, but it is good that it curled back up. But for right now, we're focusing on the 200-day and the 21. We're caught in between them, and we need to see what happens the rest of the week. Now let's go to the NASDAQ 100. Actually, a slight outperformance today, only down 1.7%. 150-day moving average is acting as resistance to that, but it's holding above the 21. So far, so good there. Let's go to the Dow Jones Industrial Average. And when I say so far, so good, I mean relative to the 21, because you can see how we've been trending for weeks above that green line, and it's really time to test it, and it's time to hold it when we do test it. Dow Jones Industrial Average outperformed today, down 1.4%, still above its 21. Now we come to mid caps and small caps, closed right on the 21, 0.3% above the 21 on the mid caps. Why are we concerned about this? Because these have been the leading index. You can see it was the first one to get above the 200-day moving average. We've been there for over 3 weeks. This is the first test of the 21 there. We do have the stochastic rolling over concern there. Small caps did break below and close below the 21 today by 0.2%. Stochastic rolled over, also failed at the 200-day moving average. Note the relative weakness for 5 weeks now on small caps. Now, why have small caps been weak, and why were they so weak today? And it comes down to understanding the sector weightings of large caps, mid caps, and small caps. Here's the S&P 500. Let me blow this up a little bit. We already know why the S&P 500 has been lagging mid caps and small caps, and it's because of the big weightings in information technology and consumer discretionary. These are really the tech and communication services to some point, but that's where primarily the tech stocks live that have been getting beaten down, the big NASDAQ 100 types. IT, 26% weight, so we already know why the S&P 500 has been down, and we've been talking about it. Healthcare and financials, meanwhile, have been outperforming, and that's why, let's bring in the S&P 400 weightings today, so you can compare this to the S&P 500. Industrials 20%. We know the Dow has been leading also. So Dow and financials and a lesser allocation to IT explains why mid caps had been outperforming and small caps until recently had been outperforming. But look at the sector allocations here: financials, industrials, financials. Look at XLF. And here's where the bad news comes in my opinion. These have been showing extreme relative strength. Look at the relative strength line here during most of this move up. There's XLF, there's XLI, industrials leading also. Kind of going sideways over the last 3 weeks, which is fine. You don't lead forever. But XLF today broke below the 21-day exponential moving average, and you can see the stochastic hooking down. Also, energy, which was the leading sector, has been weakening on a relative basis. We've been talking about that, but it also decisively broke below the 21 today and is coming into the 50-day moving average. And you can see the relative strength line is leading price lower, and that's also happening on the financials. The relative strength line is made lower lows relative to price if you compare it to 1117 here. So this to me is concerning. Now let's take a look at the banks. KBE, that's a breakdown in the banks. They've been showing relative weakness for about 3 weeks, broke below the 50-day moving average. Big breakdown in the banks, and look at stocks like Goldman Sachs, which have been really outperforming on the way up, consolidating. First move below the 21-day exponential moving average today. Let's look at Bank of America. Not leading as strongly, broke the 21, rolled over last week. It broke below the 50 today. Let's look at JP Morgan. You can see how price led there. It broke below the 21-day today. Let's look at Wells Fargo. Really broke down over the last 2 days on heavy volume. It really wasn't a leader since its earnings report last week, but the break of those major companies, the breakdown in KBE, let's also look at KRE. This is regional banks. These have been acting weak for a while. I didn't really notice how weak the regional banks had been acting relative to KBE until I took a look at that chart. KBE not quite as bad, but breaking down today, but the regional banks looking worse. And they're a big part of mid caps and small caps. The conclusion you can come to is that mid caps and small caps, if the financials continue to struggle, they're going to underperform. And that you saw that first sign today with IWM small caps breaking below their 200-day and their 21-day. The first of the big ones to have a close below, the first of the 5 major indexes to have a close below the 21. And it's not value or growth on the small caps. There's no one that's leading the other. They're both kind of weakening. A break below, you close below the 21 on growth. Here's IWN. This is the value part, below the 21, below the 200-day, relative strength lagging there also. So this is a concern with financials. I don't know if we don't know if this is a one-day move below and it's just part of a consolidation. Let's look at another financial ETF, IYF, also breaking below the 21. Is it just consolidating and it's really not that big a deal? You could think that looking at the chart, but I don't like how the relative strength is making lower lows relative to the chart. So it does have me concerned, and this is why one of the let's go to making some decisions. So I brought this up last week, and it's really something I refer to all the time. First of all, I said there was some good news today, and the good news was that if we take a look at this is an extract of the 21 over 21 list. Leaders were acting fine today. It's one of the reasons why GROTECTION outperformed. But here's a comparison of the price losses today of the 21 over 21 versus their ATR. They were all fine. Boeing actually had a gain on the day relative to its ATR. The S&P 500 was down 1.8 relative to its ATR 1.68, so it's kind of right in line. The only one of the 21 over 21 that had a loss bigger than its ATR was Halliburton, and we already discussed how the financials, or I'm sorry, the energy stocks were weak today, and it was really capping off of a weakness that we've seen recently in them. So the questions to ask is, when you're deciding what to trim, was there a change in character in the market? Not necessarily. We're still holding the 21 with the exception of small caps. So yeah, that is a change. Leading stocks acted fine. I just showed the 21 over 21 list. Growth versus value. Nothing really stood out today. Growth stocks a little bit weaker, and we know that the tech stocks that have been part of the S&P 500 and the NASDAQ 100 have been leading lower. Sector, here's where it changed. XLF showing that weakness today. KBE down 4.7%, XLF down 2.5%. All the oil sectors additionally down. So yeah, there were some sector changes today. And then you go to the individual stocks to make your decision. And we saw how Halliburton was in line with the sector weakness today on oils, and that was the only one that was that had a bigger move inside of the 21 over 21. Was volume heavy? No, the volume was fine on the leaders list. Was volatility normal? Yeah, we were down 1.8%, and the ATR is like right at 1.7% now for the S&P. So it wasn't outside of normal volatility. Then comparing stocks to the S&P 500, everything that we've bought is outperforming the S&P since purchase, with the exception of the last round of buys of the S&P 500 ETFs that we bought. And then what is my cost basis? We've got a couple of tiny losses on some of them, but for the most part, the stocks themselves are holding up well. So the leaders are the good today. The bad today was the break below the 21. The potentially ugly is the weakness in the financials and how that can carry over into the small cap and mid cap sectors. So that's the summary at a high level today. We showed all of the big sectors. We showed the financial sector. Let's take a look at some other key charts that we want to look at. The dollar strong today, and the dollar really started out basically flat and trended higher all day. And this was in line with, of course, what did the market do? It trended lower. Note this 10 o'clock spike up. There was some ISM manufacturing data that came out at 10 o'clock, and it was stronger than expected. As you know, anything strong is not good for the market right now if you're trying to fight inflation. And then after 11 o'clock, an article came out in the Wall Street Journal that said that the Fed, are probably going to cut 50 basis points on the next one, but they're targeting additional cuts next year, which would be the higher terminal rate that we've been focusing on, like 5%, and the percentage of the terminal rate ticking up above 5%. The markets bid that up today. So that is in line with the dollar going higher, interest rates going higher, and the market going lower today. Let's look at the TNX, the 10-year. Here's the rate, popped up a little bit lower and then trickled higher into the end of the day today. How about TYX? Same situation, popped higher, then lower, and then trickled higher. So the bonds themselves were down today. And again, this closes at 3 o'clock. And there was a little bit more movement in the ETFs after that 3 to 4 o'clock move. So now let's look at the VIX. What did the VIX do? We've noticed that the VIX had been oversold, which is a little bit of a concern. Let's go back to the daily chart. And the VIX popped up today. So we got two closes below this 20 level. We've been trending lower for a while in oversold territory. That's a negative. The interest rates are in oversold territory on the daily stochastic also. Let's look at the 30-year. Ticked higher, oversold. Let's look at the 10-year again. oversold, ticked higher. So again, if these start trending higher, you could see the market come off of overbought and have not necessarily a waterfall, but a fairly quick move down over the next couple of weeks. And the first cannon fire today happened with that move below the 200-day moving average. The next thing that we absolutely need to focus on is this 21-day moving average. Then let's take a look at ARK-K. Growth stocks underperformed today. ARK-K broke below its 50-day and its 21. Let's compare two charts here. Looking at multiple time frames on charts is really eye-opening sometimes. Here's the S&P 500. So here's the move up, okay? Here was the first big move up a couple of weeks ago that we consolidated. Here was the move up on Powell last week, and the trigger of how we went, how we come down over the past 3 days. Now compare that to ARK-K. Here's the move up, gave it basically all back. Here's the Powell move up, gave quite a bit of that back, not all of it, but more than the 60% that the S&P 500 has given back. And the relative weakness today on it also down 5.5%. So we added SARK to the portfolio today. This goes up as it reclaimed the 200-day with ARK-K coming down. This is ways to basically what we did is what we held is holding up okay as far as the stocks go, and we'll go through the portfolio momentarily. But what's weak today was ARK-K, and the financials were weak, and those are the areas that we focused on to bring down the overall exposure of the portfolio. So let's take a look at gold. With the dollar up, you'd think gold wouldn't have a good day, and it didn't, down 1.7% today. GDX, which had been acting fine, down 3.6% today. So as of right now, gold and gold stocks have failed at their 200-day moving average, their stochastic rolling over also. Let's move into the tail of the tape. We've already identified our good, our bad, and our ugly today, so let's start going through this. Still on the bear market rally, still on the bull cases. We're above the 21, but did have small caps close below their 21 today. Here's the news at 10 o'clock, the ISM PMI that came out that put the dollar up and the S&P 500 down. A good sign from an inflation standpoint, apartment rents fell for the third straight month, so a little bit of good news there. If you're looking for some improvement on the inflation front. So back to the tail of the tape. So, and then I mentioned Wall Street Journal, the Fed higher term rate for next year is what they're considering, while just doing 50 basis points next week at the FOMC meeting. I have in red today in the notes, XLF and XLE breaking below the 21 today. Day count from up 1 with 2 consolidations to down 1. My expectations were positive as long as we're above the 200-day moving average. Negative, broke back below the 200 today. We'll see what happens in the futures overnight and tomorrow. Levels, negative movement there, broke below the support resistance level at 40.44, the 200-day. And this fib level at 4,007. We really battled around that today for a few hours before giving it up late in the afternoon, and back below 290 on the NASDAQ 100, but still holding above this 286.82 fib. So a little bit of relative strength for a while there. Every time I would do this, we'd be below this 286.82 on the tail of the tape, but we held it today, closing at 287.64. Here are the trends during the day today. Sectors, the dollar up, yields up, marijuana stocks up, airlines up. Did that hold into the day? No, they actually ended basically flat. But that did show relative strength. Semiconductors also gave it up the end of the day to flat. Oils were up early on the Sunday meeting with OPEC, where they kept in their production cuts intact, but they turned very quickly lower and were the worst sector on the day today. ITB was weak. That's builders. Biotech weak. Solar's weak. IGV, software extremely weak. IGV down 3.7%. And KBE, the banks, we already discussed that. So what's in blue here is what we own in the portfolio. We'll go through those in addition to a few more charts. As I said, here were the changes to the portfolio with the inverse ETF on financials and the inverse ARK-K, bringing the adjusted beta down from 1.15 when we came in today to below 1, so basically in line with the S&P, but the chance for more volatility because we're not hedged directly against the S&P by focusing on financials and the growth stocks. We did add to Boeing as that continues to act extremely well and was green basically all day today. But the bottom line, weakness in XLE and XLF leads the S&P lower back below the 200-day moving average. So we gave up those two key levels of support coming into the rising 21-day exponential moving average. We don't need that on there twice. And important for that to hold. The low today, 39.84. Tomorrow, this will be in the 39.70s when we open. Okay, so let's get to the focus list now, and really it's going to be what we own, and we'll see how none of these stocks caused me any concern today. Really, I mentioned the only damage to the charts were the two oil stocks that were in there, Halliburton and Hess. Boeing acted great today. Look at the volume. It was there from the beginning of the day, and it was negative for only like about the first 30 minutes, was showing strength going back and forth today. Did give up some of the gains as the market pulled back, but you can see this. This is accumulation very clearly here. The pullback on much lighter volume than the accumulation here early in the morning. So Boeing continues to be one of the strongest. And, you know, I talked about big liquid stocks and how institutions like to move money into them if they're outperforming. And that's what's happening here with Boeing. Next up, Netflix. It's been happening there too. Not as much today as it gave back 2.4%. But after 3 strong days up, you've got a lower volume pullback day. That's what we want to see. Steel Dynamics had a really nice day up on Friday, gave back some of it today above average volume. Didn't like to see that. As long as this continues to trend above the ADMA, we're okay there. Impinj was green early, but gave it up, still holding the 21. First Solar got back into this, still in this 165 to 170 range where it's had 3 consecutive closes now, holding the 21. ANET, we bought this late on Friday. Pull back again, light volume. Anything that pulled back today, the volume was below average except for Steel Dynamics, but still holding the 21. 5 continues to act great for a gap up. Double inside day now. Volume decreasing after the monster volume on the gap up. Celsius, very volatile. Didn't give back much today. It's at the top of the range. Not a surprise that it pulled back, but it did pull back on light volume. And finally, Mobileye, extremely volatile, made a new high, pulled back, still looking okay. Smallest position that we have. So it's some additional stocks that we're focused on. SGML announced increase in their ability to produce for next year. Initially gapped up about 5%, gave some of it back, but still finished up 2.38%. Apple story out that they're moving a lot of their production out of China. Gapped up initially, ran into the 150-day reversed, but it's still holding right around the 21 and the 50. You can see I've got my alert there. We really need to have it hold those levels. That'll be key to the overall market. Tesla, there was some production cut news that came out in China. Not a good day at all for Tesla, down 6.4% after some nice 3-day action last week. And then I talked about ARK, SARK, and XLF, and that's everything that's on the focus list. So let's summarize today. The good was that leaders acted okay. The bad was that we broke back below the 200-day moving average. The potentially ugly is that financials which are a 10% weight in the S&P 500 and even bigger weights in the S&P 400 and in small caps, had a really bad day today, and that's got the potential to cause continued pressure on those indexes. So keep an eye on XLF and how it acts relative to this 21-day exponential moving average. That's going to be key. The relative strength is not there. Not as bad as energy, though. Energy has less than half the weight of what financials do. Energy, everybody's talking about the recession next year. Maybe this is finally kicking in. And the weakness in the price of oil is catching up to the oil stocks, but this is the biggest close below the 21 that we've had in a while. Coming into the 50-day moving average, you can see the stochastic rollover and approaching oversold. How long it stays there will be critical, but from a relative strength standpoint, oil's the weakest of the sectors. Financials now a close second after the move today, but it is important to monitor it going forward because of the potential big impact. Market, it's just one of those old Wall Street sayings, market can't go higher if financials aren't participating. They're the second biggest on the S&P 500, the second biggest weighting behind tech. So it's definitely cause for concern. So that's going to wrap it for today. As always, love to hear from you. Email don@revereasset.com. I know I droned on a lot today, but I think it's important. That was a bit of a change in character in financials and potentially has some big impacts. So that was the ugly for today. Or you can phone 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner, Dan Stewart. He runs the onboarding process and can talk to you about any financial questions that you have. That's dan@revereasset.com. So remember, it's not how much you make, it's how much you keep. We've got an exit plan for everything that we own. Everything that we own right now is either positive, the individual names, or slightly negative in the index ETFs that we own. We've got stops in place for all of them. How we hold the 21-day exponential moving average on the S&P 500 is going to be very critical, as well as the action relative to the 21 on the rest of the indexes. But small caps did break today after being above it for quite a long period of time. So wrapping up Monday, December 5th, this is Don Vandenbord telling it like it is. Just the facts here at Revere. Thanks for listening and have a great day.